We thought we might be finally bouncing back here. Is it just on China alone?
When we push aside the suggested rumors of production cuts from OPEC and revert to the fundamentals, you have this cross current of stagnant demand growth colliding against this very obvious resilient supply, especially here in the U.S., where we have 9.2 million barrels a day. That's our output. That's been extremely resilient over the course of the last year plus, despite this very precipitous decline in overall prices.
It has been, and who knows, we may be going back again towards our low, right, the $26 mark here, which was where we bounced off of to get to this rally. So, Bart, you say with watching oil, which, it hasn't been at these levels in 12 years or so, you're really worried about what this is going to do to the economy.
Yeah, and even though what Vince says is true, that, we've got these $9.2 million of production, we are expected to drop this year by 600 million barrels a day. But with the Iranian nuclear deal, they could make that up in a heartbeat, Betty. I mean, within a matter of months, and they could actually be trading up around 3 or 4 million barrels a day. And of course, OPEC is saying that they don't want to curtail output. They're looking for the rest of the world, Venezuela and the U.S. and Brazil,
right,
and Russia to stop production. So, yeah, I'm worried about the impact on the economy in general. Of course, for consumers, it's good. I mean, average gas price right now is $1.79 a gallon nationwide, but it's having a ripple impact, particularly not in the oil patch, of course, but sort of resounding throughout the economy, and that's got me a little concerned.
What about in the futures market? What about in the commodities futures market, where we've seen some incredible volatility? Do you think that it's
right,
almost destroying market structure?
Well, it's certainly, when you see volatile markets like this, you rely on the actual exchanges, in this case NYMEX with the West Texas Intermediate contract, and then overseas on ICE Futures Europe with their Brent contract. You rely on the exchanges to ensure that the volatility remains in check and that you have, circuit breakers in place and price collars to avoid these crazy highs and lows. But as, we've seen today, we thought it was maybe stabilizing at the $32 range, but it's already down 5% on the day. So it reminds me of that old Aerosmith song, living on the edge. You can't help yourself from falling. Some of us are hoping that it stabilizes at least pretty soon.
It definitely does feel like we're living on the edge, and particularly for some of these oil producers as well, Vince. Okay, so why haven't we seen all these oil producers who are basically paying to get this oil out from the ground? Why aren't they folding?
Well, in 2015 was a very interesting year for them. They came into the year, they were well hedged. The capital markets were indeed open. 2016, that becomes much more challenging. They're less hedged in 2016. Now, although their costs have really come on down, they've done a great job in managing their cost structures through service cost concessions, through their own operating efficiencies, drilling efficiencies. But in 2016, that becomes much more difficult, and we will likely see a more modest decline in output. Given
so just modest, not cataclysmic at all?
Well, we think that there are those producers that are in much better shape in the various basins. And while this has been a precipitous decline over the course of the last year plus, to think that we're going to see 1 million or 2 million barrels come off would be somewhat difficult to foresee. It would likely be somewhere around 500,000 barrels per day. But again, as Bart mentioned, you'll see that output be made up by Iran and other OPEC producers as well.
Bart, what about the spillover effect, as I was talking about with other commodities markets, like on coffee, on cattle, and other futures?
Yeah, these things are all interrelated. I mean, too often people don't understand that. I mean, when you have cheaper gas prices from the cheaper oil, it'll impact transportation costs, whether or not it's getting hogs or cattle or corn to market, and it'll reduce the price of those commodities. So all of this is a balancing act. We've seen a rough ride for commodities for a couple of years now, and some people have said, well, is that a precursor to another recession? But it's usually the opposite way. It's usually that, the commodities are trailing behind, and it's other bubbles in the economy, housing in 08. And so while I'm concerned about the commodity roller coaster we've seen in the last several years, and particularly on oil in the last couple of months, I remain confident overall about the commodities, and I remain optimistic about the economy, even though, like we say, live it on the edge a little bit.
So, Vince, what do you make, though, of these bullish bets on oil now? I mean, I believe hedge funds have piled in over the last several weeks, going long on oil. I mean, is that a sign of a price rise, or is that actually a bearish sign?
The market is an amalgamation of different time horizons for investors, but if you go on back to the fundamentals, you still have this significant storage overhang that we need to push through. And if we take a look at last year, from January through April, we added roughly 100 million barrels of storage to crude to storage, and so we really have a lot of wood to chop. We are now sitting with crude roughly 36% above the 5-year average. So it seems that we still have this elevated structural imbalance that we have to push through.
Okay, Vince, thank you.
Betty?
Yes?
Just real quick, I think there's two things to watch for. We've got the Iranian elections coming up on February 26th. With President Rouhani up and what happens in Iran. And then the next one, unless Vince knows that there's going to be an earlier OPEC meeting, you look to June 2nd, which is when OPEC meets again to decide in part on production. So those are two sort of dates that may have an impact on oil prices as we go forward.